We're gonna a little bit elaborate more on how credit works, how to improve credit, and how to avoid ruining a credit. So ideally, a lender is looking for a credit profile from a borrower that has at least 4 trade lines. That's usually credit cards, car loans or leases, or mortgage history, whatever that is. That's all qualified traditional trade lines. We're going to look typically at a 2-year history, and we want it to be clean. So what does it mean, clean history? Clean history means a borrower didn't ruin any of his credit by not paying in time. Running too many credit inquiries is also not a good thing, because it looks like in the eyes of a creditor that the would-be borrower is shopping a lot for credit and trying to borrow money, which means he cannot manage his finances on his own. So it's not a good indication. Now, when you do shop for a mortgage, you do have a grace period where you can apply with multiple lenders. It's not going to have an adverse impact on your credit. But if you apply for a credit card every month, that's dragging your scores down, just as a general rule of thumb. The other thing we're looking at is we're looking at your utilization rate. So what does utilization rate mean? We're going to round off numbers to explain it so you can understand it easier. Let's say you have a $10,000 limit on a certain credit card or credit line or revolving line of credit. The rule of thumb is to keep that balance always at $3,500, which is also known as 35% or less. Anything above 35%, when you cross that mark, it starts having an impact on your credit scores. Now, the credit scores and your credit activity, they work one with one together. Meaning, if you start maxing out on cards, you run inquiries, your credit scores drop, and vice versa. If you don't apply, you don't much around with your credit too much, and you don't max out on cards, then your credit scores are higher. Now, there are certain blemishes on a credit where somebody can fix it, and some are not repairable or repairable at a cost. So there are some people that specialize in credit repairs, but some are that you can do on your own. And we just had recently a borrower that started off his loan with a 687 FICO. We had him pay down some debt, and he rose his credit to 738, which saved him like 0.5% in points. So on a $500,000 loan, let's say 0.5% is $2,500 in loan costs. So either would have to take upon a higher rate or have to pay points to buy down the rate to meet the same rate as he would have gotten otherwise at the 738 FICO. Every 20 numbers on the credit scores has a different impact on the pricing and points, whether downwards or upwards, negatively or positively, beneficial for a borrower or not beneficial for a borrower. Depends which direction his credit scores are going. Now, there are some lenders that we work with, a lot of lenders that we work with actually, that if you start a loan and during that loan process you still fix your credit and raise your scores, we do another credit check and we get the lender to honor your higher credit. So sometimes it's still feasible depending on how soon somebody has to close. Ideally, we would want you to start planning all this ahead of time. Typically, a buyer that's starting to buy a home, from when they start till they settle on something, is a 3 to 6 month span. So all that can be done between that 3 and 6 month span. So I hope you find this information helpful and beneficial. If you have any questions, we're here to help again. Again, it's Yaakov with Yale Capital, NMLS number 1017498, a licensed mortgage loan originator with Yale Capital. Thank you for watching and have a great day.